How to earn interest from your own company. If you've ever loaned money to your limited company, maybe to buy equipment, cover a slow month, or just get things moving, here's something most directors don't know. You can charge your company interest on that money, and it's 100% legal, HMRC approved, and often ends up saving you tax instead of costing it. Today I'm breaking down exactly how it works, what paperwork you need, how to calculate the interest rate, how to stay compliant, and how to make sure HMRC doesn't start breathing heavily in your direction. Because let's face it, if a bank would charge your company interest, why shouldn't you? I'm Sarah from Tax for Pros, and we help UK limited company owners pay less tax, build smarter systems, and scale without the stress. Before we even touch interest rates, let's talk basics, because this whole strategy sits in one of the most misunderstood pieces of running a limited company, the director's loan account. Your company is its own legal person. It has its own bank account, its own debts, its own obligations. You might own the company, but you and the company are not the same being. Think of it like two pockets on one coat. Money can move between them, but if you mix them up, HMRC will appear like a jump scare. How directors' loans happen, accidentally, mostly. Most directors don't even realise they're doing it. You cover a few startup expenses personally. Boom! You've loaned the company money. Cash flow dips, you transfer 5k from your personal account. That's a loan. You pay for your business items on your personal card. That's a loan. Anything you spend personally for the business is money the business owes you. What about the flip side? When you owe the company money, if you take money out of the business that isn't salary, dividends, or an expense reimbursement, you might owe the company instead. That's an overdrawn director's loan account, and HMRC hates those because they look like undeclared dividends wrapped in bad decisions. So the short version, company owes you equals an opportunity. You owe the company equals HMRC nightmare fuel. Today we're living in the opportunity lane. The mindset shift nobody tells small business owners is you're not just the owner, you're also a potential lender, and lenders get paid interest. This isn't a loophole, this is standard corporate finance. You're just finally playing the same game. You take risk, company gets funding, company pays interest, you get rewarded. HMRC still gets their cut, and everyone sleeps at night. Right, now let's talk about why charging interest is actually smart. Interest just makes sense. You take the risk, you front the cash, you stop the company from flatlining, and what does the average director get for it? Absolutely nothing. Meanwhile, if you borrowed the same money from the bank, they'd slap interest on it faster than you can say press 1 to hold. So if Barclays can charge your company interest, you absolutely can too. Your company is a separate legal entity. When you lend it money, you're the lender, and lenders get compensated for risk and opportunity cost. Interest isn't greed, it's structure. Interest your company pays you is a deductible business expense. For example, if you have company profit of 50k, interest paid to you 2k. Taxable profit becomes 48k. That alone cuts your corporation tax bill by a couple of £100. Then on your personal side, interest is taxed as savings income, which is already lower than dividends. Now, before someone fires this into the comments, but Sarah, doesn't this use up your personal allowance? Let me shut that down politely but firmly. No, absolutely not. Zero overlap. Your £12,500 personal allowance is for salary. Interest is savings income, and it plays by different rules. Savings income has its own allowances. £1,000 personal savings allowance if your basic rate, £500 if your higher rate, up to £5,000 starting rate for savings if your salary is structured properly. Those stack on top of your personal allowance, they don't eat into it. So your salary sits neatly inside the £12,500. Your interest cruises through the savings allowances, and your dividends layer on top. 3 lanes, no collisions, you keep the efficiency, HMRC keeps the peace. Let's say you lent your company 20k at 6% interest, that's £1,200 back to you. The company deducts it, saving around £250 in corporation tax. You receive most of it using your savings allowance. Straightforward, clean, compliant. At Tax for Pros, we calculate the right commercial rate, draft the agreement, and handle the CT61, so everything passes HMRC's vibe check. You've built yourself a tidy little income stream from the money you already invested in your own business. Big companies do it all the time. You're just finally joining the grown-ups table. If you've ever lent your company even £10, you could be missing out on easy legal returns. All you need is a written director's loan agreement, a realistic commercial interest rate, proper accounting, CT61 filed correctly. This is how you shift from running a business to building wealth intentionally. If you want to go deeper, we've just opened the Tax for Pros YouTube membership, advanced tax planning, group structures, director strategies, and you get to choose the content as we build it. You'll also find our tax game plan linked below. That's your quick start guide to paying yourself smarter. And if you want personalised guidance, book a call with the team. We'll map the whole thing out for you, one-to-one, set your director's loan strategy up properly and get you paid efficiently. Because business isn't just about turnover, it's about structure, strategy, and keeping more of what you earn. Hit subscribe, join the membership for the deep dives, grab the tax game plan while you're here, and I'll see you in the next one.